Hello, my name is Arun Krishnamurthy, and this particular presentation, which I call Introduction to Banking, is the first of a series of presentation which I am in the process of creating. This particular presentation is meant as an introduction to banking to set the context for people who are embarking on a course or a more formal training in the law and practice of banking, either as a part of the curriculum or as a part of a self-study or kind of a distance learning course as a supplement so that they're able to understand these matters from the viewpoint of a practical banker. For I am a practical banker, and as you can see from my appearance, I have lots of experience in banking. So I thought I could share a few thoughts on the basis of banking with you. Now, first and foremost, I would like to set the stage for banking in context. And I've titled the slide, Will Banks Survive in the Electronic Age? Now, before I start or embark on this journey, I warn you that I will not entirely repeat what is stated in the slides. I would rather talk a little bit beyond what is stated in the slide just to make matters more interesting and more explanatory and trying to use examples wherever I can. In this particular case, banking in context, the entire question is this: what exactly do banks do? And with so much of revolution taking place, especially in the internet, and so much of sharing possible, and you'll talk of things like crowdfunding and so on and so forth with so many digital platforms, will banks stay relevant? But let me first tell you what banks do, or what are the key functions, or they're what I call the key reasons why banks exist. The first and foremost is that banks are trusted. They are trusted by savers as repositories of their hard-earned savings, because the savers cannot seek out investments for their money and expect that it will be returned to them safely. So bankers step into this gap between savers and investors and ensure that the savings are profitably deployed in reasonably safe assets which generate income, which can be shared with the savers in the form of interest on deposits and profits for the shareholders who provided the risk capital for the banks. And essentially, the kind of investors or the kind of people who actually borrow money from banks, they are the commercial and corporate borrowers. We all know, yes, they require large funds to set up factories, to set up businesses, to expand overseas, and so on and so forth. And the banker expects that for commercial borrowers, they will repay the bank through the success and profits of their business activities. The second type of borrower is a consumer borrower. Typically, a person who borrows, as we all know, for either buying a vehicle or buying a house, or merely to spend the money through credit card otherwise on consumables, say new TV or the latest smartphone or whatever. And such borrowers do not expect to earn the money to repay the bank out of the asset they are purchasing. Rather, they expect to repay the money out of their own future income. The second very important function that banks do is to facilitate payments for personal and trade transactions and provide cash and note exchange on behalf of the central banks. Worldwide, and especially in India, it is very important because, yes, ATMs are after an extended arm of the bank, and by law, banks are supposed to have facilities for exchange of torn and mutilated notes So therefore, and we all know that yes, we make all kinds of remittances, and plus in case we have to send money abroad, receive money from abroad, it's normally done through a banking channel. The third important function of a bank, perhaps less well known, is that they buy and sell foreign exchange and even gold from consumers, businesses and other banks. A simple example is I have to study abroad and I would need the money, say I get in admission to the Harvard School of Business. Then Harvard School of Business will expect me to pay for this education in US dollars. So therefore, I have only rupees, my savings in rupees. So I'll approach a bank in India and ask the bank to convert this rupees into US dollars and send it to the Harvard Business School. Another important function of banks is to act as a trusted third party. For instance, let us say there's a road building contract and the government says I will award the contracts only to such firms which demonstrate their earnestness of their intent to complete the contract and not give up halfway. So therefore, either they have to deposit a sum with me or they find a bank who will guarantee that in case the contractor does not perform the contract to the satisfaction of the government, the bank will unconditionally pay something like 5 to 10% of the contract value as what is called a performance bond. And similarly, other kinds of guarantee obligations are given by banks, which I will not go to here. It's just I'm trying to give you an example. And banks also an important agency function. The State Bank of India and other nationalized banks, and today even some of the private banks, act as agents for the government for basically collecting taxes and for enabling payments across the various offices of the government. Government has offices in almost every district, every taluka, every large village, and naturally the payments and collections had to be facilitated by banks functioning in those areas. Then the banks act as agencies of mutual funds. They act as agents for credit cards. Sometimes the bank does issue credit card in their name, but mostly they're issued on behalf of credit card companies. And traditionally, banks also used to provide a lot of safe custody and trusteeship services. Nowadays, it's more common for banks to enter into what are known as escrow agreements, especially supposing there is a very large infrastructure project being developed and a whole lot of banks and the finances have lent money for this particular project, say for generation of solar energy in the state of Rajasthan, which is being sold to the various electricity grids. So one of the bankers will act as a trustee, wherein all the payments from the various electricity boards and grids will be collected by this particular trustee bank and be distributed according to an agreed mechanism. So this has now become a very important function of banks. Now, a second thing you must understand is that why are banks so strictly regulated? Let me tell you that banks are strictly watched and regulated, and almost any financial newspaper that you open, you will find some news or the other of some action or the other taken on banks or for banks or some new rule being introduced and so on and so forth. That is because the primary reason why banks are so strictly regulated is that banks are repositories of public funds. Crores and crores of persons, especially with this particular direct payment system and simplified banking accounts, almost every family in this country has at least one banking account, and all of them have trusted their funds, their balances to banks. And we know fully well that banks use this money for lending to various business ventures and to consumers. Hence, it is a very onerous responsibility. And because of this, it's the task of all the governments, which is done through the central banks, to ensure that bank follow certain prudential norms to ensure that even though they have profit targets, because banks are also a business, even government owned banks, they do have profit targets. Private owned banks have the shareholders who expect a return on their money. So therefore, this has to be balanced. Profit motive has to be balanced with risk taking ability like any other business, but much more so for banks because they're dealing with public money. Therefore, banks have to manage the risks prudently. And therefore, the rules by which banks operate are fairly strict. There's another important reason why banks are so tightly regulated. It is because banks have got the tremendous money power to create money. I'm saying create by something called the multiplier effect. I have added 2 slides at the end explaining the multiplier effect. If you do stay through till the end, I will explain the multiplier effect to you, but for the moment it will suffice that as and when banks receive money from people who deposit money into the bank, they lend it to businesses. The businesses also ultimately deposit money back to the banks. So this results in the money multiplying because the money never leaves the banking system, but it multiplies as it transacts, as it passes through more and more hands through the banking system. And therefore, if you have too much of money supply, then you have inflation because too much of money created leads to more and more money chasing less and less of goods. The danger which the government and the Reserve Bank of India are always worried about. Hence, they are strictly regulated as far as these matters are concerned. A third and very important reason why banks are so strictly regulated is that a developing country like ours cannot depend entirely on market forces to allocate where deposits are deployed. Let me explain. Now, if I allow banks to choose freely whom to lend to, every bank would want to lend to a safe and huge company. Let us say they would like to ensure they lend only to, say, Tata or Infosys or Wipro or someone like that. But then they will find that these people will not pay that much of interest. So they'll tend to lend to risky borrowers. Now you can lend to a risky borrower who pays a high rate of interest, but I'm not sure that the money comes back to me. But then I also need to lend to agriculture. So therefore, I will look at an agriculturist and say, look here, this guy takes a hell of a lot of risk. And he's so poor that if he pays me a high rate of interest, then it's unlikely that he will make enough money to pay my interest. Hence, I don't want to lend to agriculture. Therefore, the government, through the Reserve Bank of India, has issued directions that all banks should lend a certain percentage of their deposits to the priority sector. Typically, it is agriculture, small businesses, and weaker sections. Weaker sections are small and marginalized farmers owning less than say 5 acres of land, and microfinance, minorities, and so on and so forth. And last but not the least is that banks deal with a lot of public and a lot of public money, and they enjoy public trust. So they need to give a fair deal to depositors, borrowers, and the public alike. They should not charge usurious rates of interest. They should not charge usurious charges. They should ensure reasonable standards of service. So all this also requires certain amount of regulation. So that's the key reasons why banks are so strictly regulated. Now, overall, the banks are part of a financial system. And in these next few slides, I will try and explain to you how the financial system in our country is structured. It is customary to divide the entities in the financial sector into organized sector and the unorganized sector. The organized sector comprises of two sets of players. One set are those entities regulated by the Reserve Bank of India. The other set is regulated by other government bodies. Now we all know that commercial banks are possibly the largest player in this particular sector, and they can be divided into various categories. There are the public sector banks, PSU banks as they are called. These include the State Bank of India, then the 14 nationalized bank who were national in the first phase in 1969, and set of another 5 or 6 banks who were national in the second phase. So these collectively are what are known as the PSU banks. Then there are the private banks, privately owned banks. Then there are the cooperative banks, and then there are the foreign banks. The foreign banks also have an important role to play because A, they bring in the latest technology and foreign expertise, and B, there will be a lot of bilateral trade between the countries, and foreign bank can expedite such bilateral trade and lending relationships. Then there are the specialized banks. These were set up somewhat recently, what are known as the payment banks, which all of us have basically sent money through UPI. So there are payment banks that specialize in sending money from one to another, and typically these payment banks were not to use their float or their money for lending and deposit taking activities, and supposed to concentrate purely on payments. Then there are the small finance banks which are mandated to lend 80% of their resources, lendable resources, to the private sector, that is agriculture, and what known as MSME, that is the medium, small and micro enterprises, and various other categories of the private sector. Apart from that, for quite almost for 3 to 4 decades, RBI has been encouraging the setup of what are known as the regional rural banks, RRBs, and local area banks. These are typically small community banks concentrated in rural areas, in specific villages, and areas which were relatively unbanked. Then the Reserve Bank of India also regulates the non-banking institutions. The most important of them are what known as the NBFCs, non-bank financial entities, which are basically everything from gold loan companies, microfinance institutions, and various kinds of companies, including companies set up by companies to just manage their own investments and financial assets. Then there are all India financial institutions. Earlier they were set up, several of them were set up, but then most of them have now either merged or they have been wound up, and what remain basically the SIDBI, which is the Small Industries Development Bank of India. Then there is something called the IFCI, and there's something called the Exim Bank. IFCI was an industrial finance corporation, which is basically a government entity and it's not doing very well. And then there is Exim Bank, which is supposed to finance export-import trade, especially which requires long duration financing. Then what are known as credit information companies. Now these companies are given a lot of importance because they collect information on the credit behavior of the various entities in the entire banking system and also the NBFCs, and they collect this information, and they are allowed to disclose certain information publicly and certain information to banks based on subscription basis, and these are very important for a bank which is making loans. Usually if I go to a bank to borrow money, invariably the bank will get a score or a report from a credit information agency, as you all must have all been bombarded with junk mails asking to offering to give you your credit score. Then there are what are known as PDs, primary dealers. These primary dealers are very large entities which are mandated with dealing with government securities, buying and selling and marketing them. And there are specialist agencies mostly set up by RBI. The most prominent one is NABARD, which basically looks after rural development and also gives finance to banks so that they can lend to agriculture activities at a cheaper rates of interest. And there's also the note printing done at Nashik. That's also under the control of the Reserve Bank of India. Like that, there are various entities. Apart from the Reserve Bank of India, there are other financial players which are regulated by other entities set up by various acts. Insurance is a very large sector, as you all know that insurance has got almost as much of a presence as perhaps the banks have, with the difference that insurance is not merely insurance, but also they have large funds available at their disposal for investment, because only a very small portion of the premium is actually paid out in the form of claims and refunds. Hence, in order to regulate insurance company, a separate body had been set up. Then there are a lot of housing finance companies, the most prominent one being HDFC, and a separate entity called the National Housing Bank. It basically is the regulator for these entities and also provides refinance, that is finance at cheaper rates to these housing finance companies. And there's also SEBI, because you know now that there's a huge activity taking place in the stock markets and also the commodity markets called the capital and commodity markets, and that's regulated by SEBI, a very powerful body. And a few years ago, the government passed legislation and set up what known as the Pension Fund Regulatory Authority. Idea being that as life expectancy increases and aging population will require pension, and then it's expected that during the course of their employment they will contribute a portion of their salaries towards a pension fund, which will essentially be managed by various agencies and regulated by this authority. Pension funds, maybe in India they are still in the hands of the government, but in most of the countries like say Canada and Australia and even the US, they form a very huge uh, financial resource which are deployed in various investments, not just within the country but also globally. Now, the fact is that every bank and finance company, big or small, needs a license from Reserve Bank of India, at least in the organized sector. There's a lot of confusion between what's a scheduled bank and what's a non-scheduled bank. There's nothing great about this. Scheduled banks are those that meet certain capital standards, and generally they're supported by Reserve Bank of India a little bit more than non-scheduled banks, which are usually small cooperative banks. And both scheduled and non-scheduled banks are subject to licensing and regulation by RBI. You must understand that a cooperative bank is set up basically by very small farmers with very modest share capital. And usually these banks, even 5 lakh of rupees may not be there in these banks, and they are borrowed and supported by the respective state governments, because as I said, everybody wants to, all the governments want to encourage the cooperative movement. Now, we talked to the organized sector. There's also a large unorganized sector. All of us would have interacted with some of the unorganized sector. There are, of course, the traditional money lenders, Mahajans, Multanis, Shroffs, Chettiars, Jains, whatever you call them. You can see them all over the place in every town and village. Then there are more sophisticated forms of money lending outside the banking system or the financial system, and that is intercorporate deposits and bill finance through brokers. Basically, intercorporate deposits where a particular, say, large corporate has got surplus funds, and they want to deploy to the short-term funds, and there is a particular corporate, another one which has got deficit funds, and as long as the surplus corporate is reasonably sure that the deficit corporate will return the money, they park the money with this particular corporate. Likewise, there are brokers who basically do a lot of bill finance. Say supposing I sell a company A sells to company B on credit. Now the company A wants the money immediately and cannot wait until company B pays. Hence, the broker will arrange through informal financiers or even people like you and me who have got some money to invest and don't mind taking the risk. And hence, company A gets its money almost upfront, and you wait until company B is willing to pay before you get the financier gets the money back. Then we all know what are chit funds and